Which one is the best growth stock to buy? Palantir, Unity, or ChargePoint? I will answer that question in this video looking across four different metrics that I'll compare these three companies on, starting with revenue growth. So let's get right into it. ChargePoint is way ahead in terms of revenue growth at 92.73% in its most recent quarter. In fact, management has forecast that by the end of fiscal year 2025, its revenues will grow to over $2 billion. That's way above where it was in its last fiscal year, as the company benefits from the rollout of electric vehicles and the billions of dollars in fiscal government spending to roll out the charger network. Unity Software, meanwhile, grew revenue at 42.77% in its most recent quarter. The company benefiting from the acquisition of Iron Source to help it with its ad sales business, its data collection and ad sales business. And Palantir Technologies coming in last place with revenue growth of 17.5%. And Palantir's revenue growth has been trending downward over the years, while the others, while ChargePoint has been increasing, and Unity, I guess you can discount Unity's growth because of the acquisition as well. The next metric I wanted to compare these three companies on is in net income over the trailing 12 months. And looking across this metric, we have ChargePoint up top here in the blue with its net income worsening down to 326 million in the trailing 12 months. In the orange, we have Unity Software net income also worsening quickly, dropping fast, going down to 921 million in its trailing 12 months, while Palantir is showing nice progress towards profitability, still losing 373 million in the trailing 12 months. However, the company was GAAP net positive in the most recent quarter, and management said that through its next fiscal year, it will be positive in terms of net income. So investors can reasonably expect Palantir's net income to be positive over the next 12 months. So that's great news for investors that like to look at stocks that generate profits, and I certainly do. I like when I see growth companies making progress towards profitability, even if they're losing money on the bottom line, like Palantir. I like that it's moving towards profitability, even though that came at the expense of growth rates. The growth rate was coming down, but I would prefer a lower growth rate if it means a profitable business. I don't mind that. I'd like slower, sustainable growth instead of rapid growth at the expense of massive losses on the bottom line. That's a lot more risky for me, and it's not really my investing style. I know a lot of other investors might be attracted to that kind of explosive growth regardless of how much money the company's losing on the bottom line. That's not my style. I don't like that. I want to see companies making progress towards profits. After all, that's money that I am trusting management with, and I want management to do a good job with the money that they are entrusted with. I want them to protect that money. I want them to grow the business and start to generate profits so that they don't need to come back and ask investors for more money, which it looks like ChargePoint and Unity might have to do if they continue. Well, I shouldn't say Unity because Unity was actually buying back shares of their stocks, but I suspect ChargePoint may need to go back to investors and ask for more money. The next metric I wanted to compare these companies on is cash flow from operations to sales over the trailing 12 months. Because sometimes tech companies, even if they're losing money on the bottom line in terms of net income, they can still be cash flow positive because they use a lot of stock based compensation, which is a non cash expense. When you give employees stock grants or stock options, you have to account for that on the income statement as for how much value that is. But it's not a cash expense, right? You're only giving employees the option or a stock, and you're diluting shareholders to pay your employees, and that's not a cash expense at the company level. So Palantir is the best in this regard, increasing its cash flow from operations to sales to 11.7% in the trailing 12 months. Then there is Unity, which is very close and had a few quarters of positive cash flow from operations, but was negative 4.27% in its trailing 12 months. And ChargePoint is going through a lot of money, negative 67% in cash flow from operations, as it's building out its charging network. That's to be understood that it's going to go through money to build out this charging network. So the last metric I will compare these three on before I make a decision on which one is the best growth stock to buy is on valuation, and I chose to use the price to sales ratio to compare the three. And in the blue here, ChargePoint is the most expensive, trading at a price to sales of 9.44. Next is Palantir at a price to sales of 8.998, and the cheapest is Unity at a price to sales of 6.884. So if I had to pick one of these three growth stocks to buy, I would say I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. Palantir is the best growth stock to buy right now. Now, I don't own any of these three growth stocks, but if I had to pick one of them to buy, I would pick Palantir. The company's the closest to profitability. It's shown the most progress in terms of profitability and the most improvement in terms of cash flow from operations to profitability. While the other two might have excellent prospects in the future and excellent revenue prospects and excellent growth prospects, Palantir so far has the most proven capability, and for me, that's the most critical, that's the most important metric. And then also, when I look at that and compare it with valuation, Palantir is in the middle of these three. So it's not like I'm having to pay this super premium valuation for Palantir because of its proven performance. I'm not even having to pay that premium. So for me, I choose Palantir here. Alright, so that's all I've got for this video. As always, I truly appreciate your viewership. Thank you for watching. And if you like this video, I'm going to link two other videos at the end here that I think you will enjoy. So click on one of those, and I'll see you over there.